This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 3, 2026, and this is the After Hours session. Now, let's get into it. We are watching a structural fracture widen in real time. The S&P 500 is effectively flat, yet the Nasdaq is bleeding momentum, and for the first time in months, the growth trade looks like it's losing its footing against a very defensive pivot. As of 16:34 ET on July 3, 2026, the tape tells us that index stability is an illusion. Before we dissect the breakdown, let's look at the schedule. We have a quiet day ahead with limited macro data releases. On the earnings front, we see AAPL, APM, BDRX, BHM, and CHR reporting today, though estimates are largely marked as N/A, keeping expectations minimal. Looking ahead to next Monday, July 8th, we have AZZ, BSET, and HEAL in the crosshairs. But honestly, with the macro backdrop, these individual prints are likely to be drowned out by the sector-wide noise. Apex, what's the one thread tying this all together?
It's the divergence itself. The market isn't reacting to a new event, it's reacting to the exhaustion of the old one. We're seeing the flight to safety play out in real time, and that's the only thread that matters right now.
Let's set the scene. The broad market, measured by SPY, closed at $744.78, down just 0.13%. But peel back the layers, and you see the engine sputtering. QQQ finished at $712.60, shedding 1.73%, while diamonds held up at $527.88, gaining 1.5%. The story here isn't a crash, it's a rotation. And not just any rotation, it's a decisive flight from technology into healthcare and financials. The technology sector, our proxy for tech, is down 2.71% on the day, marking a minus 2.16% weekly decline. Meanwhile, the healthcare sector, healthcare, is the standout performer, up 2.63% today and plus 5.21% for the week. IWP is also showing strain, closing at $297.58, near its 10-day low of $291.42. So, we have a flat S&P, a struggling Nasdaq, and a massive sector split. Pulse, where is the sentiment actually sitting? Because the VIX is whispering calm. And that's exactly why it's dangerous. The VIX is sitting at 16.59. That is deep in complacent territory. But if you look at the actual price action, the fear isn't missing. It's concentrated. We aren't seeing broad-based panic. We are seeing targeted liquidation. The sentiment score for QQQ is deeply bearish at 0.6. Compare that to Amazon, which is holding a bullish plus 0.78 sentiment score. This isn't a market-wide rejection of risk. It's a selective exit. Traders are dumping the high-beta tech names while leaving the broader indices alone. It's a pick-and-shove mentality, not a fire sale. The calm in the VIX is artificial because the selling hasn't touched the defensive bastions yet. Once the healthcare sector starts to crack, that VIX will wake up. Until then, it's a mask.
And that mask is hiding some ugly technicals. Let's look at the map. SPY is holding $744.78, which is barely above the July 2 low of $740.03. It's walking a tightrope, but the real damage is in QQQ. Price is currently at $712.60, pressing hard against the July 2 low of $707.56. This is the kill zone. If QQQ closes below $707.56, we open the door to the June 26 low at $702.81. We are seeing a compression pattern here, a coiling spring that's running out of room. Meanwhile, IWM at $297.58 is practically kissing its 10-day low of $291.42. Small caps are failing to hold support, which confirms this isn't a healthy bull market correction, it's a risk-off environment. The support is thinning out fast.
Grid is right about the levels, but he's missing the fundamental trigger. This isn't just technical compression, it's institutional liquidation. Look at AAPL. It's down 18.7% in pre-market on 9.2 times normal volume. This isn't retail panic. This is James Investment Research unwinding positions. That is a screaming red flag for the semiconductor supply chain within the technology sector. You cannot separate the technology sector's minus 2.71% daily drop from this kind of institutional flow. At the same time, look at AAPL. It's up 4.8% to $308.44, but the catalyst is America's 250th birthday. It's a non-financial, almost absurd catalyst driving volume. It's a liquidity trap. The fundamentals for the semiconductor complex are deteriorating, as shown by AAPL, while Apple's move is noise. The divergence between the technology sector's minus 2.16% weekly loss and the healthcare sector's plus 5.21% gain proves that capital is actively fleeing growth multiples for yield protection. The earnings estimates for the technology sector constituents are under pressure, and AAPL is just the canary in the coal mine.
CIPHER points to AAPL, but the real risk flag is sitting quietly in the bond market. The 10-year 2-year yield curve spread is at plus 0.35 pp, and it is flattening. Historically, a flattening curve precedes growth compression. We have CPI at 4.17% and core PCE at 3.41%, both stubbornly above the Fed's 2% target. The Fed funds rate is stuck at 3.63%. This creates a hostile denominator effect for long-duration assets. The reason the technology sector is getting crushed isn't just one stock. It's the entire mathematical structure of discounting future cash flows in a high-rate, flattening curve environment. And don't let the VIX at 16.59 fool you. That number only captures SPY options. It doesn't capture the idiosyncratic terror in AAPL or the structural decay in the technology sector. The VIX will not spike until the defenders, the financial sector and the healthcare sector, start to falter. And given the yield curve stress, they won't be immune forever.
So we have a flattening yield curve, sticky inflation, and institutional selling hitting semiconductors. Let's zoom in on the specific assets taking the hit and the ones finding refuge. First, let's talk about QQQ. It's at $712.60, down 1.73%, and sitting right on the edge of a breakdown. Grid, you flagged the $707.56 level. What happens if that breaks?
If QQQ breaches $707.56, the technical picture turns bearish. We've been in a consolidation channel, but this level is the last line of defense before a retest of $702.81. The volume profile shows diminishing bids at these lower levels. There's no support cluster between $707 and $702. It's a vacuum. If we see a daily close below $707.56, algorithms will likely trigger sell orders aimed at that June low. The momentum is clearly shifting away from the Nasdaq composition.
But remember, the technical breakdown is fueled by the fundamental flow. The minus 2.71% move in the technology sector today is the mechanical result of the institutional exits CIPHER mentioned. You're not just fighting resistance, you're fighting a change in regime. The buy the dip strategy in QQQ is dead because the earnings quality isn't there to support it anymore. AAPL is just the tip of the iceberg. If NVDA and MSFT sentiment starts to turn negative, which is still mixed, we'll see accelerated selling into technical support levels.
And the sentiment data backs that up. QQQ sentiment is 0.6. That's heavily skewed. Retail traders are still trying to catch the knife, but the institutional footprint is gone. The lack of a VIX spike means the big money isn't hedging broadly. They're just shorting the growth names selectively. So when QQQ hits $707, you won't necessarily get a wave of panic buying from the sidelines. The buyers are elsewhere, in the healthcare sector and the financial sector. That brings us to the other side of the trade, healthcare. The healthcare sector is up 2.63% today and plus 5.21% for the week. It's the best performing sector in the S&P 500. SPECTER, you mentioned this as a defensive bastion. Is it becoming a bubble?
It's becoming a destination, yes. When you have core PCE at 3.41% and a Fed funds rate of 3.63%, cash flow becomes king. Healthcare, particularly the biotech and pharma segments within the healthcare sector, offers predictable revenues regardless of the business cycle. The plus 5.21% weekly gain is a direct response to the 10-year, 2-year flattening. Investors are paying a premium for certainty. But here's the risk. As everyone piles into the healthcare sector, the entry point gets crowded. If the yield curve continues to flatten while inflation remains sticky, even the healthcare sector will face valuation pressure. It's safe, but it's expensive. The flight to safety has turned into a fight for space.
Exactly, and look at the contrast. The technology sector is down minus 2.16% weekly, while the healthcare sector is up plus 5.21%. That's a massive relative strength gap. The funds are rotating out of high-multiple tech and into cash flow positive defensives. This isn't a temporary blip. It's a structural re-rating of the market. The AAPL sell-off is accelerating this shift. When a major supplier like AAPL drops 18.7% on institutional selling, it forces analysts to revise estimates for the entire sector. Those revised estimates mean lower multiples for tech stocks. So the healthcare sector isn't just safe, it's becoming the new benchmark for value in a high-rate environment.
What about small caps? IWM is at $297.58, down 0.58%, and hovering near its 10-day low of $291.42. It's lagging both the large-cap tech and the defensive plays. Is this the canary for the broader economy?
It's a weaker canary. IWM is closing near the bottom of its 10-day range. Small caps are sensitive to borrowing costs, and with the 10-year, 2-year spread flattening and rates holding at 3.63%, the refinancing wall is looming for mid-sized companies. Technically, the chart is ugly. There's no bounce off the $291 level. The path of least resistance is sideways to down until we see a clear reversal candle. Compared to diamonds, which is up 1.5%, IWM is being abandoned. This confirms that the soft landing narrative is fraying for the smaller, more leveraged parts of the market.
Don't forget the dollar. The trade-weighted dollar index is at 120.89, down only 0.17 week over week. A strong dollar hurts multinational small caps. Combine that with the yield curve flattening, and you have a perfect storm for IWM. It's not just technical, it's macro. Small caps are caught between high rates and a strong currency, unless the Fed signals a pivot. And with CPI at 4.17%, they won't. IWM has no tailwind. It's drifting.
Finally, let's touch on AAPL. It's up 4.8% to $308.44, driven by a news headline about America's 250th birthday. CIPHER, you called this a liquidity trap. Why?
Because there's zero fundamental justification for a 4.8% gap up on a patriotic news ticker. The sentiment for AAPL is mixed at 0.2, while Amazon is bullish at plus 0.78. This move is purely speculative. It's a volume spike, 7.3 times normal, but without institutional conviction, it's a trap. Traders chasing the news will find themselves trapped when the novelty wears off. In a market where the technology sector is dropping 2.71% on real earnings concerns, AAPL move stands out as an outlier. It's a distraction. Don't mistake volume for value.
Agreed. The crowd is attracted to the narrative, but the smart money is ignoring it. The sentiment data shows that while retail might be clicking on the news, the institutional flow data doesn't support a sustained breakout. It's a one-day wonder in a sea of red. If AAPL can't hold $308 on low volume tomorrow, it'll snap back quickly. It's a sucker's bet in a risk-off environment. So we have a fractured market. Tech is rotting from the inside out, driven by yield curve fears and institutional exits like AAPL's. Defensives like the healthcare sector are soaring, but getting crowded. Small caps are crumbling under rate pressure, and the VIX is sleeping, unaware of the chaos. Apex tie this together. Where do we stand?
We are standing in a low-vol, high-stress anomaly. Grid flagged the technical vulnerability at $707.56 for QQQ, and CIPHER showed that the fundamental driver, the AAPL's liquidation, is severing the link between price and value in tech. Pulse correctly identified that the VIX at 16.59 is a lagging indicator, masking the selective fear in the technology sector. SPECTER reminded us that the yield curve flattening makes the healthcare sector attractive, but risky if the rotation spreads. The takeaway is simple: the market is no longer a monolith. SPY's flatness is a mirage. The alpha destruction is happening in the technology sector, and the defense is happening in the healthcare sector. Treat them as two different asset classes until the technical breakdown confirms the trend.
Here is your snapshot of the aftermath. 1. Q is testing critical support at $707.56. A break below exposes $702.81. 2. The technology sector is undergoing a structural rotation out of growth, led by institutional selling in names like AAPL. 3. The healthcare sector is the current winner, up 5.21% weekly, but crowded and vulnerable to yield curve shocks. 4. The VIX at 16.59 is misleading. Ignore the Broadcom and watch the sector splits. Tomorrow, we watch for a daily close on Q. Does it hold the line, or does the rotation accelerate into Monday? This has been ShadowQuant Equities Edition. Stay sharp, stay skeptical, and trade the data, not the noise. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.